Welcome to the Deep Dive. We're here to give you the crucial takeaways from today's key earnings calls without all the usual fluff.
Exactly. We cut through the corporate speak.
Today, it's Skillsoft. We're looking at their fourth quarter and full fiscal year 2025 results.
And our mission, as always, is to pull out what experienced investors really need to know.
Let's jump right in. How did they actually do?
Well, pretty solid, actually. Skillsoft wrapped up the year quite strong. Revenue came in above the high end of their own guidance.
Okay, that's a good sign.
Yeah. And adjusted EBITDA was also right up there at the upper end of their range.
And crucially, what about that transformation plan they keep talking about?
They said it's still on track. They seem confident it sets them up for a return to growth in fiscal 26.
Okay. And any key metrics that jumped out, like dollar retention?
Yep, DRR. It hit 105% in Q4.
105, wow.
Which brought the last 12 months figure to exactly 100%, so right on target with what they expected.
Okay, good. So this transformation, let's dig into that. What are they actually trying to do? What's the core strategy?
Right. It's basically two big things. First, they call it fixing the basics.
Fixing the basics.
Like operational execution, getting more productive, improving margins, the foundational stuff.
Makes sense.
And the second part?
That's invest to grow. So taking resources and deliberately putting them where they think they can beat the market growth rates.
Okay, so reallocating. Where's the focus in this first phase?
Right now, it seems to be heavily on go-to-market, how they sell and product. They think that's where they can get the quickest momentum boost.
And within that invest to grow piece, where are those investment dollars heading?
A really big push towards the enterprise segment. That seems to be the key.
Enterprise. Okay.
They're talking about shifting up to 20% maybe of their go-to-market and product resources specifically into enterprise for FY26.
20% is significant. So what happens to the other segments? Well, while they shift focus to enterprise, they're also aiming to make the other segments more efficient, drive efficiency there.
So it's about spending more to get and keep those big enterprise customers and building out features for them.
Exactly. More advanced capabilities tailored specifically for those larger, often more complex organizations.
They threw out a huge number for the total addressable market, didn't they?
Yeah.
Something like $400 billion.
Yeah, over $400 billion. But, they're not trying to boil the ocean. They're targeting specific, fast-growing parts of that market.
And how do they see themselves standing out? What's their unique angle?
They really emphasized being essentially the only player owning and offering global skills development across lots of different learning methods, all at scale.
So breadth and modality.
Right. And a big focus on interactive learning, leveraging AI. They see AI as key to speeding up workforce transformation for clients, helping them manage talent development better.
Okay, strategy makes sense. What about concrete financial commitments they talked about?
Well, for fiscal 25, the year just ended, they committed to finding at least $45 million in annualized cost savings on a run rate basis.
$45 million. Did they hit it?
They did. And the plan was always to reinvest about 40–50% of that back into the business.
And that reinvestment continued.
Yep. Continuing into fiscal 26, mostly weighted towards the first half of the year. And importantly, they stuck to their guns on returning to top-line growth, expanding margins, and having positive free cash flow in FY26.
Okay, so the commitment's still there. Let's pivot to product. What were the highlights? What did they emphasize?
Continued build out of their Percipio platform, focusing on enterprise features and integrations. That seems constant.
Right.
Their AI coach, Skillsoft Casey, was a big mention. It hit over 1 million launches.
1 million, okay. What does it do again?
It offers these ready-made scenarios for learning, targeted at tech and business skills. They also ran a preview program with about 100 enterprise clients, letting them test out new functionality where customers can actually author their own AI simulations with Casey.
Oh, interesting. So customers can customize the AI training.
Exactly. And they plan to launch that more broadly later in fiscal 26.
AI is clearly a huge focus. Anything else significant on the product side?
Yeah, a couple things. Percipio now lets clients build and manage their own certification paths.
So custom internal certifications.
Right. Helps with measuring impact, internal mobility, that sort of thing.
Yeah.
And some of those enterprise certification features are now also in Codecademy's new certification hub for individual learners.
Bringing enterprise features to individuals, too. Makes sense.
And they streamline the user experience, apparently cutting the time to schedule a first coaching session in half, down from 18 days to 9.
That's a noticeable improvement.
Definitely. Oh, and new integrations. SAP Talent Intelligence Hub, Pluralsight, BigThink Plus, Oracle, and their own LMS, Debo. connecting more dots in the enterprise ecosystem.
Okay, let's talk go-to-market. How are they actually selling this stuff? Any highlights there?
Yeah, they broke it down a bit. In the global knowledge, or GK segment, their top 10 deals were worth almost $6 million in total contract value.
What drove those deals?
They pointed to trainer expertise, key partnerships like Microsoft and AWS, and their net promoter score, so learner satisfaction.
Okay. And the other segment, talent development solutions, TDS.
That's where the bigger deals are. Top 10 deals there represented $22 million in TCV.
Much larger. What's the focus in those TDS deals?
Usually multi-year agreements focused on, comprehensive skill building, measurement, integrations, and giving clients choice in how they learn.
Did they give any specific customer examples?
They did. Mention Honda using Skillsoft for enhancing digital skills across North America as part of a bigger transformation.
Okay, big name.
And Virgin Media O2 in the UK, partnering to build out a learning ecosystem for 16,000 employees.
Wow. So definitely targeting those larger enterprises.
Absolutely. The strategy seems very focused on the higher end of the market, investing in salespeople with deep expertise in enterprise learning and digital strategy.
All right, let's get into the nitty-gritty financials. How did the revenue break down by segment?
Okay, so for Q4, TDS revenue was $102.8 million. That was up just 1% year over year.
Basically flat for TDS in Q4.
And the full year?
Full year TDS was $450.5 million, also pretty much flat compared to FY24. FX had a bit of a negative impact there.
Okay, and global knowledge, GK.
GK saw a bigger drop. Q4 revenue was $30.9 million, down 13% year over year. Full year was $125.4 million, down 15%.
Still declining, but maybe slowing?
Yeah, they did say the rate of decline in GK improved in the second half of the year, so maybe starting to stabilize a bit.
And total revenue then?
Total for Q4 was $133.8 million, down about 2.8% year over year. And the full year landed at $531 million, down 4% from the previous year.
Okay, so top line's still slightly down overall. Right. What about costs and profitability? Were they managing expenses well?
Seems like it. Cost of revenue was down 12% year over year, both in Q4 and for the full year. That came from lower variable and fixed costs.
12% is a good drop. Other expense lines. Content and software development costs were also down, 12% in Q4 and 6% for the full year. They linked that to productivity gains, partly from using AI.
Interesting. Selling and marketing.
Flat in Q4 year over year, but down 5% for the full year. They said that was due to more targeted advertising spend.
But G&A was up.
Yeah, general and administrative costs increased a bit, 4% in Q4, 5% for the full year. Mostly tech investments and higher bonus accruals.
Okay, so overall operating expenses.
Overall down 5% in Q4 and down 6% for the full fiscal year. So good cost control overall.
And how did all that translate to the bottom line, adjusted EBITDA?
Adjusted EBITDA looked pretty good. $29.9 million in Q4, which is 22% of revenue. That's up from $28.3 million or 21% revenue last year.
So margin expansion in Q4, full year?
Full year adjusted EBITDA was $109.1 million or 21% of revenue. Also up from $105.1 million or 19% revenue the year before. Again, showing that benefit from resource reallocation and cost discipline.
And net income, GAAP and adjusted.
GAAP net loss improved quite a bit, both Q4 and full year, compared to the prior year. Adjusted net income was basically flat year over year in Q4 at $17 million, and for the full year, it ticked up slightly to $35 million from $34 million.
Okay. Let's talk cash flow and the balance sheet. How are they looking there?
Cash flow showed really strong improvement. Free cash flow in Q4 was $13.2 million, way up from $5.4 million last year.
Big jump. And the full year?
Full year free cash flow was $11.6 million compared to only $1.5 million in FY24. And if you look at adjusted free cash flow, excluding restructuring costs, that was even higher at $33 million for the full year.
So generating decent cash, what about their cash balance and debt?
They ended the year with $103 million in cash, equivalents, and restricted cash. Pretty healthy. Total gross debt was $581 million, down a bit from $591 million in Q3.
So leverage improved?
Yep. Gross debt leverage went from 6 times down to 5.3 times, and net debt also decreased down to around $477 million.
Okay, balance sheet strengthening a bit. Looking forward now, what's the guidance for fiscal 26?
All right, for the upcoming year, FY26, they're guiding revenue between $530 million and $545 million.
So implying a return to growth for the full year compared to the $531 million in FY25.
Exactly. Adjusted EBITDA is projected between $112 million and $118 million.
Continued EBITDA growth.
Right. And they expect positive free cash flow again, targeting a range of $13 million to $18 million. They also gave an unlevered free cash flow number, excluding net debt servicing, anticipated between $71 million and $76 million.
Okay, so the guidance seems to align with their goals of returning to growth and expanding margins, albeit maybe modestly on the margin front initially.
Yeah, that seems right.
Now, the Q&A with analysts is always interesting. Did anything crucial pop up there?
Yeah, a few things. Predictably, there were questions about the macro environment, government policy changes, things like that.
And their take?
Management said they haven't really seen a material hit yet, but they're watching the uncertainty closely. Importantly, the FY26 guidance doesn't assume any major negative impact from that uncertainty.
Okay, so the guidance assumes things stay relatively stable. What else?
They explained why margin expansion might be modest in FY26. It's because of those reinvestments we talked about, happening mostly in the first half, which are meant to fuel growth later in the year.
So investing now for growth later makes sense.
They also reminded everyone about seasonality. Q4 is always their biggest booking quarter, like 45–50% of the annual total. And Q1 is typically the smallest for revenue and EBITDA. They expect that pattern to hold for FY26.
Good context on seasonality. Any other key points from the analysts?
Yeah, they talked about progress on the go-to-market changes, especially seeing strong, large deal activity in the TDS segment. Focuses on beefing up the enterprise teams and getting growth from recent acquisitions.
What about the AI pilot, the Casey simulator?
Apparently, strong engagement there. Customers were particularly interested in using it for customer-facing revenue generation use cases. And quite a few of the pilot customers also signed up for professional services.
Interesting upsell potential there. Anything on improving the global knowledge segment?
Yeah, they're working on the GK margin profile, trying to boost the top line, focus more training on their own proprietary IP, and optimize a reseller mix. They expect sequential improvement there through FY26 and into FY27.
And that improved dollar retention rate, do they think it's sustainable?
They seem confident, pointing to more multi-year contracts, plus ongoing improvements in customer success and the product itself. They feel it's durable.
Okay. And they have levers to pull if the economy does worsen.
Yeah, they stress they have flexibility to manage profitability and investment levels depending on what happens with the macro picture, trying to balance profitable growth with those strategic long-term bets.
All right, time for our favorite speculative segment. This is not financial advice. Let's throw out some outrageous but plausible trade ideas based on everything we just heard.
Okay, purely thinking out loud here. Given that big push into enterprise and the AI focus, what if you went long Skillsoft, but paired it with a short position?
Shorting what?
Shorting, say, a more traditional corporate training company, one that's maybe still heavily reliant on classroom-style stuff, in-person seminars, and hasn't really embraced AI or digital transformation as aggressively.
So the thesis is Skillsoft steals share from the laggards?
Basically, yeah. Skillsoft's forward-looking approach helps them win in enterprise, while the old guard faces headwinds. Plausible? Maybe outrageous.
Definitely fits the bill. Got another one.
Okay, second idea, playing off those integrations, SAP, LMSs, etc. Skillsoft's success could drive demand for related services.
Like what?
Maybe look for potential long opportunities in companies that specialize in enterprise software integration, particularly connecting learning platforms to HR systems. Or maybe even smaller niche companies developing complementary AI-driven HR tech that could plug into ecosystems like Skillsoft's.
So betting on the ecosystem growing around Skillsoft.
Exactly. As Skillsoft gains traction in large companies, these adjacent services and tech providers could benefit. Again, total speculation, not advice.
Got it. Purely hypothetical. Okay, that wraps up our deep dive into the Skillsoft earnings call.
We've pulled out the core insights, the strategic shift, the AI progress, the financial targets.
Hopefully this gives you the context you need to stay informed. Remember, critical thinking and doing your own homework is always key.
Absolutely. What stood out to you? Did this raise new questions? Keep digging deeper.
Join us next time on the deep dive for another focused analysis.